Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast. I'm your host, Matt Halloran, of course, with Chuck and Mark. Now, this is a two-parter, everybody. We just talked about buy bonds, right? Which is why Nepsis and the Clarity roadmap and all of the sort of investing with clarity is why they don't actually want to invest in bonds. And you need to go back and listen to that. But this, we're going to dive into the great valuation reset. There's some stuff happening right now that's very, very important for you to understand, and so that you truly have the clarity that you need to have in your investments. And with that, take it away, Chuck.
You got it. Thanks, Matt. And thanks, Mark, for our part two here, the great valuation reset, as Matt teed it up. So if we make a bridge from our past Buy Bonds podcast to this, what are we going to try to get at here? Is that we had foreseen, right, going back again to around 2010 to 2014, that we were going to see bonds not be a viable investment for the most part for our clients' portfolio. So we just lay that out on the table.
Yeah.
Bonds artificially grew in price, right? Because their yields were dampened by Fed policy, right?
Right. Remember, explain the teeter totter effect, right?
We didn't, and that was in the last.
Yeah. So let's explain why they lose or make money on bonds on the capital itself, right? Explain the teeter totter to them. We've done it in the previous podcast, but let's tell people that now, because one of the things we probably didn't spend enough time on last podcast to get people to understand the risk of owning bonds. Most investors view risk as loss of principal. So as they watch the value of their bond go down, it's a loss of principal. But if they hold the bond to duration, they get their principal back, right? Because when the bond matures, you get your capital back. So, and most investors probably view the losses as price depreciation of that bond. The reality is, even if the bond goes back to par and you get all your money back, you can lose money, not just in the price of the bond short term, but you can lose, more importantly, purchasing power. And as the bond goes to maturity and you get all your money back, you haven't lost, quote unquote, your money, but more importantly, you've lost purchasing power. It's like I always say to people, I use the ridiculous analogy, and I'm going to do it, and then I'm going to give it back to you, okay? I always tell people, would you be happy if the average rate of your return of your portfolio every year was 40%? Ooh. Every single person is going to say,
you could hear a pin drop on that one.
40% per year, and that's guaranteed? Yes, 40% guaranteed. I'll invest with you in a heartbeat. But then you throw in the caveat. What if inflation is 80%? Is 40% a good rate of return? Not a chance. No way. Not a chance. Returns are relative. Most people focus on what's the rate of return on my portfolio, but really what the focus should be on is how much purchasing power am I gaining or losing over a 3 or 5 year period. Now, everything's down right now. Obviously, short term does not make an investment portfolio. It's long term. But as you look at purchasing power, and this is what we got into the buy bond scenario with from 2010, not only were they down for that period, but more importantly, you lost purchasing power, and people do not understand the importance of that. Okay. There's my, what's that?
Your spiel?
My spiel. There's my spiel for you. Go ahead, Chuck.
I thought it was well said. My goodness. So let's get to what you just said and unpack it, right? So let's go back to that last piece we were talking about, the buy bonds, right? The original theme we had, 2010, the 10-year treasury yield is 3.4%, right? So picture this. We have this timeline where it drops. We go through the COVID crash, right? And in August of 2020, the 10-year treasury is at 0.5. So what was it? That was about a 10.5-year trip where rates kind of went down. So what people think to themselves is, oh, I could have purchased bonds and I could have sold them and I would have made money, right? Because their yield dropped, their price went up. But here's the important thing, Mark. We use bonds not necessarily as an investment opportunity, but as a vehicle to view what are we going to pay for a future dollar of a company's earnings. Now, how does that even kind of relate to one another, right?
Yep.
It is huge. And here's why. You mentioned in the last podcast the cost of capital. And when a business is growing, they're borrowing money for the future, a lower rate for them makes it directly to the bottom line. And in that scenario, Mark, you want to own highly levered growth stocks, right? Because those companies that are speculative, that are borrowing for the future, their cost of capital is much lower. So in the decade of the 2010s, we had a higher price earnings ratio, right? We were willing to pay more for a future dollar of earnings because our rates were lower. So I want to pass that to you. And let's just stop at that point in August of 2020.
Yep.
So go ahead, please.
Yeah. So that's exactly right. So when you look at the cost of capital going down, people can take more risk.
You got it.
This is what happens in a market where the Feds coming out of COVID were just printing money. So there was a lot more capital floating around the market, and people who had access to that capital were able to go invest in investments or loan money out to people at much higher interest rates, but effectively not understanding the risks associated with that. Because the reality is the spigot always dries up. The day comes when the spigot dries up. And that's what's happened in 2022. And so a lot of people are down 30, 40, 50% in their portfolios right now because they owned a lot of companies that were growth oriented in nature, meaning they were borrowing a lot of money or they were putting out a lot more equity, putting more stock for sale, and money was out there to go buy that stock so that these companies could have the capital. And that well has dried up, and it's going to continue to dry up. And so, hence the term, the Great Reset, is we are going to get back to lower annual rate of returns on equities, more reasonable rate of returns on equities, quote unquote indexes, and more importantly, values of company stock. They don't go up every year.
Got it.
And when you get in a world where it's gone up every year for the most part, people lose sight of reality. I hate to say it, as do money managers and financial advisors. Because the reality is, in most portfolios, investors own so many stocks that they don't even know what's going on with their portfolio. How much growth do they have? Where's their greatest exposure? What's their largest holding? And this is the problem with the traditional money management format, where people own hundreds, if not thousands of stocks in their portfolio, right? It's not an opinion, this is fact. Now, let's scrape that back. Let's scrape that scab off for a second. If you've got 500 companies in your portfolio and you literally have just gone through and going through what we are going through right now, with the NASDAQ down 30+%, S&P down 20+%, do you really think that every single of those 500 or 1,000 or 2,000 stocks that you own in your portfolio are the best companies to own in your portfolio in this new economy? No chance. That's fact. That's not an opinion. No one can say the 500 companies I own in my portfolio are the best 500 companies to own right now, because that could change literally on a daily basis. That's the power of flexibility and transparency, knowing what you own, why you own it, the ability to know what you own and why you own it, and the ability to take advantage of buying the best businesses at the time to own long-term in your portfolio. That is a major part of what we call the Great Reset.
Mark, excellent. And I want to just take that and parlay right off of it, because here's why. It's easy with hindsight for economists to suggest, hey, we had the easy money era of the last decade. It culminated right with COVID and the monies that were sent out to the general public, ZIRP, or zero interest rate policy. But we actually acted upon it, right? That flexibility. So let's go back. We've talked about this before, but we're walking through March of 2020, right? We get hit by this thing called COVID-19. No one knows where it's going. But in essence, we said to ourselves, hey, there are some opportunities. So we started looking at companies that had sold off significantly. As we walked through that period to basically September of 2020, we made our own reset, right? I want you to tell the audience about what we were saying to ourselves. Oil had hit negative price in April of that year. Rates had bottomed. The reopening was underway. COVID is bad, but it wasn't a redo of the Spanish flu of 100 years ago. And in essence, we saw unbelievable bargains in the quote unquote value space. And I want to talk a little bit about that transition and why we think that's going to hold true as we go into the future.
Well, Matt may yell at me for this when we're done, or you may yell at me for what I'm about to say. I know many people who are way, way, way smarter than me. Many would say the fact that I got out of high school and college is a miracle in and of itself. There are people way smarter than me. But the one thing that I think that I have been blessed with is common sense. And my dad used to always say, common sense is uncommon. And I believe that unequivocally.
Got it.
And that leads into, why we talk a lot about process before progress. We don't publish returns. People will say, why do you not publish your returns? Is that because they're not good enough? They're not that great? And I say, really? We've been here 26 years. We still have our first 2 or 3 clients. And you're telling me that we're not good at what we do? That's not a logical explanation for why you don't publish returns. Process is the most important aspect of progress. The philosophy and the strategy of how you go about making decisions in an investment portfolio. So go back to the fall of 2020, summer of 2020. Do you remember what a barrel of oil was trading at? It was negative.
It was negative for 3 days in April of 2020. Absolutely.
Yeah. Oil was negative.
Yes.
Yeah, we need oil every day. And if you walked around and talked to everybody you knew and said, do you think that we are going to be locked up forever and the economy is never going to open? No one would ever say that, because guess what? There have been other pandemics in history. This is not the first pandemic we've had. So an economy is going to open up. Now, a lot of people want to get in the weeds and they want to talk about the real intricate components of everything going on within markets and their portfolios, because it helps them look smart. And people go, gee, that person really knows what he's talking about. And I sit there and I go, that is completely the most ridiculous thing I've ever heard in my life. That makes no sense at all. How can you say that companies that were growing like Peloton, like DocuSign, like some of these other Zoom stocks that were going through the roof, trading at ridiculous multiples? By the way, hashtag multiples do matter. Valuations do matter. They don't matter all the time, but when they matter, whoo boy, you better make sure you got the right valuation. And so the point is, as you went through 2020, you knew the economy was going to open up, meaning that the energy needs, the needs for food, the needs to open up for travel, the needs for vacation, the needs for clothing, the needs for real estate, everything that got shut down because an economy shut down is going to have to reopen. It's no wonder you had supply chain constraints. It's no wonder you didn't have enough stuff produced to manage an economy coming out of a pandemic, because the economy has never come out of a pandemic this big before. So when you go back, hindsight's always 2020, but back in those days, say like as a long time ago, mid 2020s. In fact, I told someone the other day, go back and listen to the podcast we did, Matt, back in March and April of the pandemic. This is exactly what we talked about. And we're long-term thinkers. We're not short-term thinkers. And so while we're never going to get the bottom exactly right in where you invest in, the one thing I did know is that the Feds are going to stop printing money at some point. They're going to pull that money back in. That's what they're doing. So the less money available to invest means the investor is going to get wiser about where they put that money to work. This is not rocket science, folks. Investors are going to put their money where it's most suitable for investment. And it wasn't going to be in companies that were valued on price on sales and how quickly their revenue was growing, but they're still losing money and having to go get more money to make more money. Valuations eventually matter. And we started positioning portfolios. We're down significantly less than any index that you want to look at in the equities market. And that's even after great returns we had before that. My point in saying that is that the moves we made, the Great Reset, started 18 months ago, not in March when the markets were down. It's a process of understanding that valuations matter, cost of capital is going to go up, the availability of capital is going to go down. You better own companies that pay dividends and give money back to their shareholders and are businesses that are not going to go away. They're going to grow over time. And that's what we did.
And I love it. And what we call that is quality. And that was so exceptionally well said. I love when you mentioned fundamentals matter, valuations matter. So let me just kind of roll this up, Mark, here. Lay this out kind of in a timeline, right? So we had, which is called ZIRP, right? ZIRP, the zero interest rate policy of the Feds, really coming out of, would say, the last 8 years or so, going back to 2016, 2017. They had excessive borrowing at low rates, right, which fueled speculation. And then all of a sudden reality hit, right? And what I want to make this transition between what you just spoke about in this obsession with owning low-cost index funds or low-cost sector funds. And remember the advertisement a couple of years ago, I think it was Matt Pearson that saw this and brought it to our attention, where they talked about these sector index funds wipe away single stock risk. And that was the talk of the day, right?
Yeah.
So how has
why
that...
Why take single stock risk when you can own the whole sector? Because every company in the sector is a great company. Come on.
That's what they're saying. It's like we have this homogeneous or monolithic set of properties that
they're going to market to the max. If you're going to, if you're going to market, sorry, I'm so on fire today. I keep interrupting you.
So I want you to speak to that piece about how we're going back to not only the basics of understanding the business itself and why you're owning it and what you do with that business over time is going to lead us into, I think, a decade or much longer, hopefully never looking over our shoulder at what we just witnessed over the last 10 years, this indexing mania.
This is
Take it away.
This is why we first take a top-down look. What are the sectors we want to invest in? There's not a lot of sectors we want to invest in, quite frankly. That's why we only own 20 to 30 companies in our portfolio, maybe 35 at any given time. We look at the greatest sectors we want to own from a long-term perspective. Okay, so that's number one. Number two, when you invest in when you market to the masses, which is what these commercials are and these companies do, they market to the masses.
They do.
The only way they can effectively attempt to get a return on their investment is to make the message general enough that you catch enough fish. In other words, they throw a big net out there, hoping it spreads wide enough that they catch as many fish as possible. Okay. But I believe, contrary to that, I believe that you find the greatest fishing holes and you cast a smaller net and get better fish. In other words, we don't market to the masses. We invest in specific businesses over time. So we don't have to talk about the macro aspect. It's like saying oil. Is oil for the foreseeable future really going to go away? Is the need for oil really going to go away? No. Is the need to go to a hospital going to go away? Is the need to eat going to go away? All of these things are important, right? And so when you talk about utilization of your capital, where is my capital best invested? It's invested in areas that have predictable income in the future. They're companies that are going to be able to adapt to bob and weave in cyclical market changes, recessions, non-recessions, expansion, contraction, right? And so when you get let me ask you this, Chuck, when you get super sick or you want the best healthcare, the best food, the best automobiles, the best clothes, for the best clothes, the best this and that, do you go to the big department stores? Do you go to, big Costco's or Walmart's or Dollar Generals to get it? No. When you want the best of the best, you are sniper rifle approach to what you want. You go to a very specific clothing manufacturer. You go to a very specific doctor, AKA a specialist. You go to a very specific automobile dealership. My simple question is, why don't investors do that? They hope and pray. That's why people always say the stock market is nothing more than a gamble, because they have no idea what they're investing in and why they're investing in it in the first place.
Mark and Fuego, double dittos. Can I give you a couple of factual pieces to, as always, support what you're saying?
As my head of research should, please do.
So, tying in the two podcasts, we talked about interest rates, right? In the effect that they have, again, on the cost of capital. It is amazing if you take a look at interest rates, which is called them 10-year treasury yields over time, whether they're high or low, and what the average price earnings ratio is on the overall equity markets. There is what we call nearly a complete 100% negative correlation in the movements. Now, what does that mean? As one goes up, the other goes down, and vice versa. And when you talked about macroeconomic top-down overlays, that's how we use certain components. It goes into the process, right? If the cost of capital is rising, I want to own companies that borrow less than borrow more, right? That have a higher profit growth than less, right?
Yes.
Because the rate of interest is higher. And I want to own those that reward the loyalty of their shareholders, who are the owners. And how do they do that? As you said, they return capital, meaning they buy shares in the open marketplace because they're confident that they're buying them at a lower price. And they simply increase that quarterly check that we so cherish that's sent to our account every month and every quarter. That's what's called a dividend. That's all it really is, right? It's the wealthy companies with the confidence that can simply say, you know what? The future, we're very confident in, we're going to send even more back to our owners, our shareholders, because we have an understanding of our business better than anybody else. Well, that's what ownership is all about. Correct me if I'm wrong on that.
Correct. 100%. The only other piece I'd add to that is that one of the most important aspects of the businesses you want to own, because people say, look, with rising inflation, companies are less profitable. So there has to be a valuation, the valuations of the index have to come down. The S&P today is at about 15 and a half times next year's earnings, give or take.
Yeah, just under 16.
Down from like 24, 25.
Yeah.
Short-term movements of a stock are irrelevant to the extent that all they really do is give you a snapshot in time and allow you the ability to buy more of a great business on sale. Because the reality is, when the dust settles, and the dust always does settle, The companies that ultimately in an inflationary environment that have pricing power, we've talked about purchasing power.
Pricing power.
Company that has pricing power is going to be able to increase the prices to maintain the profitability and maintain the dividends in their company because they have that pricing power. Companies want pricing power. Investors want purchasing power. When you can line the two together, you have yourselves the making of a good, tasty cake. I have no idea what that means, but I'm kind of hungry, so I brought up cake.
That's okay. Plus, you've had your birthday within the last 10 days or so, I think, right? So, I won't tell you on that.
I got younger again.
Yeah, that's okay. You do. You look great. I got one thing that I want to end this on, if it's okay, and I want to talk about this. I don't want it to be this wonky statistic. I want you to make it alive. So you take the price earnings ratio, which we've quoted, right? Which would you say is 15.5?
Yeah, just to explain real quick. Sorry, because you're my research guy. I'm the breaks it down simply. Price to earnings ratio is the price. So the earnings divided by shares outstanding, right? So a price to earnings ratio of 15, right, means a stock trades at 15 times the amount of money they make with shares.
Per share. You got it. Okay, so let me do it. So I want to turn that upside down, the P over the E, and make it the E over the P. So let's just say the price earnings ratio would just make it up as 16 over 1. If you take 1 in the numerator, 16 in the denominator, you get what's called the earnings yield, which is roughly a little over 6%. So it's former Fed chair Alan Greenspan who came up with this thing called the Fed model. So here's going to tie in the buy bonds with the great valuation reset. The earning yields on equities, broadly speaking, forward earnings is a little over 6%. Bonds will become competitive with stocks when that high quality corporate or 10-year treasury yield gets to 6%.
Bingo.
Before that, right, I am simply saying that earnings that I'm going to be receiving in the future, the yield of that for what I'm paying, and that doesn't even include the dividend, right? That means that rates would even have to almost double from here, which we think they're going to rise, but they're not going to double before, again, bonds become this great investment that they maybe were in the 40s and 50s. But I want you to just end with that and talk a little bit about that, if you could, please.
It's simple. Risk adjusted return. How much risk am I going to take to get the return I'm going to get? And bonds are not going to give it to me. They're not. They haven't, and they won't for a while. And it's going to be owning the companies that have the characteristics that we have discussed today that are going to do that. And I couldn't say better what you just said. I think what you just said completely encapsulates the last two podcasts. And if people want to be good stewards of the resources they have, they want to multiply those resources, understanding what you own, why you own it, and what you pay for that relative to your overall allocation strategy is paramount. It's critical. And we call that investing with clarity.
Excellent. What do you think, Matt?
Yeah.
You fell off your chair almost.
I did. There were a couple of times there where Mark's fuego was translating all the way over here in Michigan. So yeah, what do I think? Well, I think number one, that the numbers, the statistics, the explanations of each of those statistics are things that people really need to chew on. They should probably go back and listen to these two episodes again, because it's so important to challenge the way that you're thinking, but not just to challenge it, to force you to understand more about what your statements mean that you're getting quarterly, and what your advisor and what the general public is saying. That is incorrect, fundamentally incorrect. The other thing too, that I love that you guys say all the time is volatility is opportunity, right? And Mark, you were talking about FedEx, right? And I know this is not any sort of an advertisement for FedEx, and I'm going to go ahead and use my own disclosure and disclaimer there. But the idea, ask yourself the question, is that going away? Is FedEx going? I love, what are you eating? What are you driving? What are you doing? Those are questions I feel, guys, has just been lost
100%
in the world of investing.
100%. I always say to people, everyone's complaining about the gas prices. And I'm saying, look, I know it impacts people, but if you want to hedge, own some oil companies. If you don't like the cost of your healthcare, own some insurance companies, right? I mean, that's how you hedge your position, and you keep pace with your ability to have purchasing power that stays ahead of inflation. And you are dead on. People, I used to use this analogy, and I'm going to get it wrong. I used to use it before the financial crisis. I used to own Boston Beer, Visa. I owned Visa and a couple other companies. I can't remember what they are, but I used to always use the analogy that, I would go to the gas station, fill up my car. Thank you for my Devon Energy. I swiped my Visa card to buy my gasoline. Thank you very much. And then I headed over to the health club with my Under Armour clothes on and did an exercise. I owned Under Armour at the time. And then when I was done working, I went home and had a Sam Adams. All companies I own, right? It's the idea of investing in what you know. Now, investing in what you know is important. It's good. It's not always going to be a great investment because there's a lot of great companies out there right now getting hammered, and they're great companies, but they're not great investments. And that's very different and hard for people to comprehend. So your point is dead on and well taken.
And this is why you hire somebody like Nepsis, because there is a difference between great companies and great investments. And if you hire somebody who has somebody like Chuck on the team, who does massive amounts of research, and you've got, this whole disciplined team and process in place, this is how you guys can start truly understanding what you own and why you own it, and having real clarity around what you want to be when you grow up, because it's all different for everybody, right? And your money is supposed to be that tool to help you have the freedom to do the things that you work really hard for. Why don't you want to have clarity surrounding those things? It just doesn't make sense to me. And that's why everybody should subscribe to the show. That's why you need to share the show. Thank you, everybody, for paying attention to this two-part episode, making sure that you guys truly understand what the heck's going on, not only in the markets, but valuations and bonds. And with that, we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.